Okay, good afternoon, everybody. Thanks for attending our tax planning webinar. Last time we had a chance to talk with you guys on a webinar was at the end of October, and we promised to follow up with some tax planning strategies when everything cleared up. Nothing cleared up, but we're going to give you some year-end pointers anyway, and we're going to try to keep this short. It's hard to have a meaningful tax discussion in less than 15 minutes, but that is our goal for today. So Dennis, can you kind of fast forward and maybe lay the groundwork for where we are, at least with respect to the election, before we get into some of the proposed tax changes?
Sure. So as we sit here today, it appears that former Vice President Biden will take the White House and become president in January. One thing that is clear is that Democrats will continue to hold power in the House, although with fewer seats than they had before in the last Congress. But the Senate is still up for grabs. Right now, it looks like we have 50 seats controlled by Republicans and 48 seats controlled by Democrats. The two remaining seats in Georgia will be decided by a special runoff that won't happen until January. So these two seats are significant because if the Democrats win both the seats, the vice president would have the deciding vote in the event of a tie, which gives the Democrats a majority and allows them to completely change the landscape of US tax policies. If Republicans get just one seat, which is believed to be the case, they'll get at least one, they will continue to have control of the Senate and would be able to keep major tax changes from happening. So it looks like we're likely to see at least a couple more years of muted changes, which the markets have reacted to positively over the past few weeks. But let's see what changes, what tax changes have been proposed by Biden to get an idea of what may change if the Democrats do win those two seats.
So we're not going to cover every one of the tax law changes proposed by Biden, but here are the 6 most important. And if any of these affect you, it'd probably be worth you giving us a phone call or an email, and let's have a further dialogue about it. First of all, let's talk about the elimination of the step up in basis on inherited assets. That would be a huge change of current tax law and tax policy. Today, if you pass away and you own an investment or a piece of land where you've got a very large capital gain in that investment or piece of property, you pass away with that, your heirs take not your cost basis, but they step up to the fair market value at the date of death. So what that means is that all of the capital gain related to let's say a stock or a piece of property or whatever gets eliminated and forgiven forever. So if that is taken out, then your kids and your grandkids could face a significant tax liability upon your death. If that's the situation that you're facing, again, get us on the horn. Gift and estate taxes. Currently, the exemption is $11.58 million per person, $23 million per couple. So it's really not been much of a concern for most Americans. There was talk on the campaign trail that Biden would like to lower that back to $5 million, where it stood before the Tax Cuts and Jobs Act. And by the way, even if Biden doesn't get his way here, the Tax Cuts and Jobs Act, which was became law in 2017, will lower this exemption down to $5 million anyway when that law sunsets. So sooner or later, it's very likely that the estate tax exemption is going to get lowered. Again, if that affects you, get us on the horn. Let's talk to you and your accountant, maybe your trust and estates lawyer, about what might be a smart thing to do. There has been a lot of talk about raising the top marginal income tax rate. Currently, that rate is 37%. Biden has proposed raising the top marginal rate back to 39.6%, but only for people that make more than $400,000 annually in taxable income. The Social Security tax, you don't pay any Social Security tax above $137,000 under current law. Biden has talked about bringing that in again on people earning more than $400,000 a year. He's talked about requiring those earning that amount of money to pay Social Security taxes. And Social Security taxes are 6.2% for the employee, 6.2% for the employer, 12.4% if you're self-employed. So if you are self-employed or you have some control over how you're paid, whether it's in the form of wages or salary or partnership distributions or S Corp distributions, that might be something that we might want to have a dialogue about. Itemized deductions, there's currently no cap on itemized deductions. Biden wants to cap the tax benefit of itemized deductions to 28%, which obviously if you're in a higher tax bracket than 28%, you'd lose a little bit of the value of your itemized deductions. And finally, long-term capital gains and dividends. There's been a lot of talk about how Biden wants to come in and eliminate the preferential treatment for long-term capital gains. That only applies, and Biden has made it clear, Biden's the folks on Biden's campaign have made it clear that they have not talked about raising the capital gains rate for anyone earning less than $1 million a year. So a lot of people are very up in arms about this taxation of capital gains. Only applies if you're likely to earn more than $1 million in 2021 and going forward. If that's your situation, we probably ought to have a conversation after this webinar.
Right. There we go.
Yeah, I mean, this is just a reminder that because of Corona, and we had this CARES Act in March, eliminating RMDs or required minimum distributions. So if you are age 7.5 or older, you do not have to take a required minimum distribution from your IRA or from your 401k or from your simple. No RMDs are required for 2020. If you have taken an RMD within the past 60 days, you might want to get us on the horn. Maybe we can figure out a way to get that rolled back over and eliminate the income tax on that distribution. But in any event, no required minimum distributions for tax year 2020.
So while we don't know what tax changes may be coming, one thing we do know is that tax rates are currently at historic lows. And so it's likely we'll see these rates rise in the coming years, no matter what party is in control. So knowing that, one thing that may be beneficial to you is to do a Roth conversion. And so this is where we take money from your traditional IRA, we pay the tax now, and then roll that money into your Roth IRA, where it grows tax-free, and you're also not forced to take a required minimum distribution in the future from the Roth IRA. So honestly, Roth conversions don't make sense much of the time if you plan on using the money within 15 to 20 years and your income is not likely to change. But if you're currently in a lower tax bracket, or it's going to be money that's likely to go to your heirs, it might make sense to do this, and especially if we can do what we call really fill in the bucket. And here's an illustration of what I'm talking about. So you may find yourself in the middle of one of these tax brackets with room to add more income without pushing yourself in the next tax bracket. So for example, here in 2020, the 22% tax bracket for married couples goes from $80,000 to about $171,000. So if you're filing a joint return, you see your taxable income is at $100,000. Well, that means you could add about $71,000 of income without going into that next tax bracket. You could fill that bucket. And so making a Roth IRA conversion could make sense in a time like that. An example where we have seen this make sense, we've had a few clients that have retired. They're not yet taking Social Security, and they have after-tax money saved up for income, so they really don't show any income. And so we've been able to do a Roth conversion up to the 12% bracket, which if you're married is $80,000. And then once they, later on, when they start receiving Social Security and take income from IRAs, things like that, they may be in the 24% bracket. So we can pay half of that rate right now on a conversion. That's one of the times it's pretty much a no-brainer. And again, as I mentioned before, when you do this, it lowers the required minimum distribution you're forced to take from your IRA later, so it lowers your taxes in the future.
Something to keep in mind as well are qualified charitable distributions, sometimes called QCDs. And this is where you take money, give money directly from your IRA to your church or to any other charity that you want to gift to. So it reduces your IRA balance, again, thereby reducing your required minimum distributions in the future. There's zero cost to you. Up to $100,000, you can make a donation out of your IRA directly to a qualified 501c3 organization. You pay no tax. The charity pays no tax. you lower your IRA balances, thereby lowering future RMDs. It's really a win-win. And even though the Secure Act extended the age at which you got to start required minimum distributions from 70.5 to 72, if you're 70.5 or older, you can still do these qualified charitable distributions. So again, it's probably the most efficient way to give to your favorite charity for most taxpayers.
Exactly. Yeah, another item, as Brian mentioned before briefly, is the possibility of a reduced estate and gift exemption. So currently it's sitting at 11.5 million per person, 23 million per married couple. But if this is a concern, there are a few things you can do to help lower the estate, your estate amount without having any gift taxes. So first is the annual exclusion. So each person can gift up to $15,000 per year to each recipient. A married couple can give up to $30,000 per year without facing any gift taxes. On top of that, you can make tuition payments directly to an educational organization for someone, and payments made directly to a healthcare provider for a person's medical care are not treated as taxable gifts. So an example would be if you gift $15,000 to a grandchild, then you can also in the same year make a payment directly to that same grandchild's private school or college, and that's not treated as a taxable gift. And so then the third tier of this is using your lifetime exemption, which again is $11.5 million per person, and could go down sooner, but it will in 2026. It's scheduled to go back to 5 million and 10 million per couple. So if that's a concern, again, give us a call, and you could, we need to do that now, and talk with your CPAs and estate planning attorney.
Yeah, so here's sort of a kitchen sink laundry list of some of the things we talked about and not talked about. But if your taxable income is very likely to be over $400,000 next year and the ensuing years, and you have any control over when you receive that income, get us on the horn. We might want to figure out a way to accelerate that income into this year. By the same token, if it's very likely that you're going to have taxable income over $1 million in 2021, you may want to consider actually taking or harvesting some capital gains now to avoid higher capital gains or income taxes at a later date. The higher tax rates go, the more valuable tax advantaged investments are. Municipal bonds, if you don't own enough of those in your non-IRA or non-Roth accounts, that might be something to beef up. If you're a aligned portfolio management client, we're already doing this for you. Same thing with item number 4. So many people are, let's call it, being overly patriotic with their investment portfolios, where they own these big dividend paying stocks. We all love dividends, or they own, big dividend paying REITs outside of a tax sheltered account like an IRA or a 401k or a Roth. Why not move that and hold it inside of your IRA or your Roth, and then own, like for instance, tax-free bonds in your taxable account? Think about your gains and your losses, and it's still important to harvest your your tax losses. Tax loss harvesting, as tax rates go up, the value of those tax losses goes up, as well. So tax loss harvesting is still a very important discipline, and it's something that we try to pay very close attention to. We booked a lot of tax losses in March and April.
Yeah.
All of our portfolios are way up today, but in any event, we took some of those losses when we had them, and now most of our clients have very nice tax write-offs because of that. And in light of everything that we've talked about, the lowering of the personal exemption from 11.5 million to 5 million, the death of the stretch IRA. Now your kids, if they inherit your IRA, got to take the money out within 10 years of your date of death. They can't stretch it out over their lifetime. So it's probably a pretty good time to be reviewing perhaps your entire estate plan, including the beneficiary designations on all of your IRAs and your 401ks. So that's really all that we had for today. Again, we're just an email or a phone call away. We hope this has been helpful, and really appreciate you taking the time.
Take care, everyone.
Thank you.